My name is Jimmy Lee. I'm the CEO of the Wealth Consulting Group. I also serve on the investment committee for the Wealth Consulting Group. And with me today is Jim Worden. Jim is our Chief Investment Officer at WCG. He's also a CFA, CMT, a CAIA. And we also have Dr. Chris Rand, who is a Ph.D., CFP, and CLU. Both Jim and Chris and I all serve on WCG's investment committee, working with all of our partners, our independent investment advisors and their firms, helping to do research, trading, and manage portfolios for the wealth management aspect of all the work that they do and we do for our clients. And so we're really here to talk about what's going on in the market today. We think today's an important day to have a call like this because we've had some recent volatility that caused the market to dip below the closing low for the S&P 500 for the year as of September 26th today. So that there's a little bit of significance with that in terms of technical analysis. So we're going to give you a little bit of update of what we think is going on in the marketplace, our view on the economy a bit, and then also talk a lot about behavioral finance, which we believe has the most to do with how successful investors are or not over their lifetime of investing. So we're going to ask Dr. Rand a lot of questions on that. He's taught classes to students on the subject, and so I'm really looking forward to it. But before we get into that, we want to talk about the market. And of course, the biggest word in the news today is inflation. And it's been the biggest word, or the most important word, for a long time now. And I'm going to ask Jim to talk a little bit about inflation and how that plays into where we're at today, because I think the argument is for market technicians in terms of what's going to happen very short term in the stock market is that if the Fed continues to raise rates, which they've indicated they're going to do, and I think we have another 1.25% priced in based on the futures market in terms of what they believe and what the Fed's indicated that they may do in terms of the federal funds rate. But at the end of next year, that estimate goes all the way down to 2.5%. That's according to the Federal Reserve dot plot and estimates that they give out. And so we've got increasing interest rates and then declining interest rates later on. And I think, again, the argument or the questions that are being asked and the debate is whether or not the stock market falls. And if the economy falls apart and goes into not a technical recession, but a bad recession where there's a lot of job losses, or can there be a reversal of that? My personal view is that the path to a soft landing, as the Fed has called it all year long, meaning that they can increase interest rates, curb demand by making borrowing costs much higher, demand from consumers spending money, and companies from spending money and borrowing money by increasing interest rates. And we know that's affected a lot of markets, especially housing, with mortgage rates nearly or more than doubling since the lows in a very short time period. But can there be a path to potentially create a soft landing so that we don't have a bad recession with a lot of bad job losses? We really believe, and I personally believe, that that's really going to depend on the next few, readings of inflation. So if there's a chance, if we get inflation reports for the next several months that look better than expected, I still think there's a narrow chance that we could have potentially a soft landing. And what we'll talk about is the potential for a large rally, especially for the equities markets nearing year end and beyond. But with that, let's talk about inflation, Jim. Where are we at with inflation? And what's this chart here telling us?
Yeah, thanks, Jimmy. Good to be with you. And I agree with what you're saying in terms of, the Fed's path to that soft landing. That path is getting narrower and narrower the longer we go on with them tightening. What we're looking at here is we're looking at the money supply, which is the orange line. And we saw this spike dramatically, right, during COVID. Massive amounts of money that was injected into the markets, liquidity. And if you look at this going back to the 70s, we've had prior periods where we also saw massive amounts of money supply increase prior to inflation increasing. So this is the inflation is a lagging indicator of what's happened with money supply. Now we've seen that money supply has gone from roughly 26, 27% increase down. And we're looking at a money supply of 5%. So we would expect that due to this, inflation will continue to come down, and we're seeing it. We're seeing it in the housing market. We're seeing it in manufacturing data. We're seeing it in commodities. That these things are indicating that inflation is coming down. The challenge that we're in right now, however, is that the Federal Reserve, that is looking almost exclusively at this backward data, saying that as inflation is still high. The higher that they raise rates and the longer that this goes on, that they keep their foot on the brakes with the economy, that the greater the chance that we do enter into a recession.
Okay. The next slide talks about midterm elections. And, historically, I know that during midterm election years, I think the statistic is that since 1950, I believe, the S&P 500 goes down by an average of around 17%, and then bottoms near the end of summer, beginning of fall, which is, pretty close to where we're at right now seasonally. But then a year later, the market's up a lot more. What does this chart tell us, Jim, about midterm election years and volatility, et cetera?
Yeah, there's a lot of good charts on this. This one is actually from Capital Group. This goes back to 1931, and it's basically averaging out all of the non-midterm election years. That's the gray line. That's a pretty normal line. That shows that the market is on average going up quarter after quarter. And it's a pretty normal line. The blue line is the average midterm election year going back to 1931. And so you can see that this chart is just largely moving sideways and actually down some on average until we get to October and November, December. And on average, we have a good run with the equities. And so that's what we're looking at here. And I think that as we have gone through multiple rate hikes, and as we get closer to the midterm election, it's quite possible that the Federal Reserve pauses. That would be very good news for the market, and markets could follow similar to what other midterm election years have done. It's going to look a little bit different than average, but we've certainly gone through a lot this year. And so the potential is there for us to have a good bounce later on this year.
Thanks, Jim. And I think, what's important to note is that I know investors must think, after seeing a slide like that, then why wouldn't you just get out of the market, in the midterm election years? We're gonna answer that on a later slide, but the next slide actually talks about the consumer and the strength of the consumer, because all of this year we've had some record numbers when it comes to the amount of money consumers have on the balance sheets and checking accounts and money markets and all that type of stuff. What does this slide tell us about household net worth and where the consumer is, Jim?
Yeah, great question. So if you look back in the 1970s and 1980s, this chart was going down. You see that line is going down. Households were having a much harder time the last time we had really high inflation, late 70s, early 80s. It was a difficult time for consumers. We had much higher unemployment. And we can see here during this period of 2010 to 2020, and even through COVID, household net worth as a percentage of disposable income has increased dramatically. So we do feel that even if we do have some high inflation, and even if we do have a mild recession, consumers are in a pretty good spot to weather the storm comparatively to other periods where we've had recessions in the past.
Yeah, it seems like the consumer is still being very resilient. And for those of you listening, the consumer makes up approximately 70% of the gross domestic product, basically the economy of the United States. And so the health of the consumer is extremely important. And as you saw in a previous slide, a lot of the money supply that was produced by the government, has come down. And so, which had a lot to do with obviously inflation. So did COVID and some of the issues that we still have to deal with today, companies to deal with in terms of supply shortages. And so as supply shortages improve and that situation gets better, obviously the government, Federal Reserve increasing interest rates, their intention is to curb demand. And that's kind of the tough part, is it's a tug of war. While we don't want the economy, and the Fed doesn't want the economy to go into a toilet, they want to, have demand go down and people spend less money. So it may sound a little confusing. And I think that what's been a little bit disappointing for a lot of us investors is that this entire year, Chairman Powell, who represents the Federal Reserve Board, the bank, has been saying that he's been trying to, and they have been trying to engineer a soft landing while they need to increase interest rates. And obviously they were very late to the game at increasing interest rates. So I think most critics, believe that they started increasing rates much too late in the game, and inflation got out of control a little bit, and now are having to increase interest rates way too quickly. And I think that's a consensus today, that they're not allowing the effects of higher rates kind of get into the data. And we don't know exactly why they may be doing it this way, but we think they're making a mistake. But, what they've consistently said is that, they're going to follow the data. And I still think that's true. So if we get a few consistent prints of lower inflation, is when we think the Fed will actually come out and say, we're going to pause for now. And who knows if it's going to be this year. I think there's a decent chance before the end of the year that could happen. And that rhetoric that I was talking about, a soft landing, was what Chairman Powell was talking about all year long until Jackson Hole, where there was a meeting, an economic meeting of a lot of investors and government officials in Jackson Hole not that long ago. And that meeting is when he stated that, we know we're going to cause some economic pain. And that was the first time that, he had mentioned and used those words, which really investors didn't like at all. And then that was followed up with a fairly, not necessarily a horrible, but a little bit higher inflation report for the month of August. And that's what's really helped perpetuate, the stock market going down, as we had a nice recovery from the June lows. So this next slide is one of my favorite slides. It's really what I think is a big part of what makes a great financial advisor, meaning that this is typically how investors look at the stock market and how their emotions correlate with the stock market. So as you can see, this chart is just an example of something that's going up and down. And as you can see, if you look at the start from start, where when it's the stock market, if you're going to look at this chart, and the chart represents the stock market, as it goes up, you start to get optimistic, then you get excited, then you start getting thrilled. And at the top of the market is when usually we see euphoria. People are very euphoric. We start having clients ask us, about their neighbors' portfolios that went up 60%, even though they went up 20%, and those kinds of things. And that's when a lot of people are interested in getting into very speculative investments. And we've had to talk investors away from that, right? And then as the market starts to go down, they start getting into denial a little bit about what's going on. Anxiety then steps in, and then fear, and then possibly depression. And then it's usually about when panic starts to set in and people get really nervous, and then you hit capitulation, is when the panic and capitulation areas, is when most people end up wanting to get out of the market, or do get out of the market and sell their investments. And then there's despondency. And then as the market goes back up, people are skeptical about what's going on in the recovery. Then they start to get hope, relief, and then the cycle starts all over again with optimism. So this is very typical of what we see with investor behavior. And, I've been in the business 27 years. Jim and Chris have been in the business for a long time as well. And we've seen charts consistently show us and given us data with statistics about how the average, let's say the stock mutual fund did XYZ rate of return, but shareholders in the exact same funds do a lot less. I mean, like a lot less than 50% less in most cases. And I always like to ask people when I show that chart, why do you think that is? And then, people will say, well, it's probably because of fees. Well, those were after fees. They may give other reasons. It's really because people like to buy high and sell low. So because we're all attached to our money, We get very emotional with our money. That's why having a fiduciary, an independent person whose job is to put your interest above anything else, and having an objective relationship from that basis is a better way to approach how to invest money. So this is a great chart to talk about behaviors, which is a great segue to talk about some of the things I'm going to ask Dr. Rand here in a minute. But you may have asked, or you may be thinking, why is it that you guys don't know what's going to happen, or why you don't get in and out of the market? Well, this is a great slide to talk about that. The title of this is Time in the Market versus Timing the Market. And, if you could look at this chart, if you use a buy and hold strategy, this is starting from December 29th of 1989 through December 31st of 2021, a buy and hold strategy in S&P 500 earned an investor a 10.8% annual return. Pretty darn good returns. Look a lot like the historical averages that I'm sure that you're aware of. But if you miss just the top 5 best days, the return goes down from 10.8 to 9.2. And if you miss the best 25 days, it goes down to approximately half almost of 5.6%. And so if you think about the number of days over the number of years that we're talking about, it's a very small percentage of days that if you missed being out of the market, mean invested in the market, you're in cash. Either you did it on your own or you talked to your advisor through hopefully many discussions that you just can't stand it anymore. And if you went to cash, look what happens to the returns. And then, by the way, when do you think the biggest gain days are? The biggest gain days, a lot of times follow the biggest loss days. So it's after those big, huge loss days, the day right after you get those big gain days. So if you're not invested in or near the bottoms, you just don't get the market returns. That is one of the big reasons why we as advisors just do not promote trying to time the market. One of the, kind of a funny things I like to ask people is, have you ever looked at the world's wealthiest people? Look at it and see if there's any market timers on there. There really aren't, right? The name of an investor that stands out is Warren Buffett, who's been famous to have a buy and hold strategy. He doesn't really care about what's going on in the marketplace, as long as the companies that he owns still have great management, which he invested into, and are still doing a good job of running their company. And even in bad cycles of the economy, during bad business cycles where we actually may be in a recession. Now, we as advisors, one of the things that we will do is that when the stock market gets a little bit expensive and pricey, we'll try to rotate the type of investments within a portfolio so that, maybe we don't go down quite as much as what the S&P 500 might, or an index might go down during a decline. And vice versa. We may want to favor different sectors or under allocate different areas that we think are going to do better in different time frames, or even style of investments like value stocks versus growth stocks, which has finally come back into favor this year. And I can tell you that our investment committee, I think we've done a pretty darn good job of doing that and producing some really great results for our investors this year, being overweight in some sectors like energy all year long, and in value, and underweighting technology really before the war started and the stock market really started to go down this year. And so this is another great slide to talk about crisis events for a very long time period since 1929, starting with the stock market crash of 1929 that kind of kicked off the Great Depression, or was a big part of the Great Depression. And in a very short time period, as you can see, how much the gain and loss column says the market went down. This is the Dow Jones Industrial Average. And then what the returns were, 1 month, 3 months, 6 months, and 12 months later. So I know that Chris has had the slide up for a minute here, but there are a lot of different things that have occurred here, as you can see, including the financial crisis, the Lehman Brothers event, when they collapsed during the financial crisis, what happened. And, during that short time period when that was announced, 6 months later, the Dow was down 32%, but had recovered a lot 12 months later, as you can see. And then, as we all know, March 9th of 2009 was a bottom, but we know that what the market did after that, right? And then look what happened during COVID, during those, during that period from February 12th of 2020 to, March of 23 of the same year, down 37%. But 1 year later, the Dow Jones Industrial Average being up over 74%. So as you can see, the average is 12 months later after a crisis event is almost 19%. Now, this as well as a lot of other slides that we get access to that we hopefully can share with clients, show that even the returns after market bottoms are a lot better. So I'll give you another statistic. According to some research from Carson Wealth, when the American investor investment survey comes out, and the number of people that are surveyed goes over 60% that are bearish. When that happens, 12 months later, the S&P 500 goes up by an average of 33%. And so there's a lot of statistics out there that which suggest that we're either close or getting close to bottoms. And by the way, that happened on September 22nd, not too long ago, right? Just a few days ago. So a lot of statistics that people can look at and we can look at to try to reassure our clients that getting out of the market right now is not the right idea. Trying to time the market, go in and out of the market is probably never a great idea. We know that when investors are thinking about doing that, it's even worse when financial advisors try to do that too. And so we really try to stick to our knitting and understanding where it is that we can add value. And it's not to try to predict what's going to happen next month in the stock market, even if that's what investors think that's what our job is. That's really not our job. And so, we are earning our money now, having many conversations with clients, reassuring them that everything is going to be okay, and everything is going to be okay. And there are going to be some catalysts that we're going to get coming up, not in the long-term future, but in the near-term future, that could actually change the dynamic of the market. The most important being if we get lower inflation and the Fed finally signaling that they're going to stop raising interest rates. But by the time they say that, the stock market's probably going to be up a lot. Investors are going to smell that out and sniff that out and invest ahead of that. So, but the next few slides, we're going to talk about investor behavior, which I think is fascinating. Next slide, Chris. This is an interesting concept. I'm going to have Dr. Rand talk about it, but anchoring is something that is relevant and in a lot of investors' minds. So Chris, why don't you explain that to us?
Yeah, and before I jump into anchoring, I just want to go back and reiterate something that you were just talking about, Jimmy. I think the three of us would agree we're well beyond euphoria, and we're not sure where we are past that point, but probably closer to the bottom than the top. And I've been doing this for 26 years, Jimmy. You've been in the business for 27 years, Jim, very similar to that, and managing clients' money, but most importantly, as an advisor, managing clients' behavior, and having these conversations with your advisors at this point is just so important. So we can talk through and remind them of this slide. Really sits home with me, Jimmy. The best 25 days, to your point, usually follow those really, really bad market days. And it's really easy to miss those if you do get out. And so as it relates to anchoring, as we think about behavioral finance, what is it? It's where you're relying on something that you know. So it's this bias where you think about something that's what you're going to rely on. And I love asking clients or people when I speak to or students, what did you pay for the first gallon of gasoline? For me, it was 78 cents a gallon, the Arco station near the high school that I went to when I turned 16 years old. And when I've done investment seminars and I ask this question, you're really telling your age, aren't you, when you answer this question, especially out loud in the audience? Someone that says 30 or 40 cents a gallon is, much older than someone who says $4 a gallon. But that's something that we naturally will anchor to. We'll say, geez, I remember when gas cost 78 cents or $1 or $2. What did you pay for your first home? I can't tell you how many conversations I have with clients over the last year or 2 years. They go, man, I would not buy my house for what it's supposedly worth today. I remember when a home should cost, and kind of fill in that blank. So for the home or for the gallon of gas, that's your anchor. What did you pay for the first car that you purchased? Chances are really good the last car that you bought is probably 4 or 5 times the cost of the first car that you purchased. But again, your anchor is back to that. And then what did you get with your first investment experience? And this is more related to our investor clients. Did you have a good experience? Maybe you made 10% your first year or two, or a bad experience, maybe you lost 10% first year or two. Regardless of what it was, what your experience was is your anchor. And why that's important is that investors, we tend to anchor to the last thing that we remember. In the case of investment account statements, people are very likely anchoring to their beginning of the year account statement, or maybe right at the end of last year, November, December. That's when the markets were, over the top. And so what you're thinking behaviorally is it going to come back? Am I going to ever see, whatever that account balance was? And in your mind, that's your goal now, whether you realize it or not, is you've told yourself that I need to get back to that level. And investors also may anchor to that first investment experience they had. If they, historically had a really good experience, and they're always thinking back to, that great investment that they had, and why is maybe my investments right now not quite performing as well. And anchoring really leads into a couple different biases that we have. And this one, unfortunately, we're talking about this one today. For many, many years, we didn't have too many investment losses, at least on a year-by-year basis. But this year we typically do. And there's this academic theory called loss aversion. And what loss aversion basically says is that an investment loss is worse than an equivalent investment gain. Now that makes sense, doesn't it? People don't like to lose money. Of course, we're gonna not be as happy to lose money as we are when we earn money. But what the academics and the researchers have found is that your typical investors' loss aversion is about 2 to 1. In other words, they are 2 times less happy, I guess would be the best way to think about that, with a loss than they are with the equivalent gain. So if your investment goes down 10%, you're going to be 2 times less happy than you will if it went ahead and it went up by 10%. And so I think it's just, it's important to know how we react to losses in general, and keeping in mind, and what I just mentioned a minute ago as it relates to biases, that anchor. We're already experiencing loss aversion when we see account balances that are down, and then we're still anchored back to that, that original price point, very likely something back the early part of this year or the end of last year, at least at this point. And then we want to focus on that getting back to par. It's almost more important than other fundamentals as it relates to the investment. So let's say you bought a stock for $100 a share and it's now down to 80. Your loss aversion bias and our anchoring bias is going to say we want to get back to 100. And I know a lot of times with advisors will tell me that, well, I've talked to my client and I really think we need to get out of this investment because of whatever the reason is. The fundamentals aren't good, and we should switch it for investment A for investment B. And the client will say, well, I just want to get back to $100, and then let's go ahead and talk about that change. And so it's that us being loss averse and our biases as we're looking at that and forgetting to pay attention to those fundamentals. And so having a good strategic investment strategy is really a great way to deal with these various biases that we have, and that's something that our investment committee does when they work with the money that we manage. But more importantly, I think it's the strategy that you have with your advisor. And if as I've talked to clients through numerous down periods over my career, usually the first 2 or 3 questions will be, well, have your investment goals changed? No. Has your timeline to retirement changed? No, not really. Do you think things are going to get better in the future over the next whatever time period? Yeah, I think they're going to get better. We have a strategy. We should stick to what that strategy is. So I can talk a little bit more about other biases if that's okay with you, Jimmy.
Please do. It'd be great.
At this point. And so, going on this theme of investor biases, we've got a lot of them. We already talked about loss aversion. Another one we don't talk about as much, although we do talk about this occasionally on our investment committee, is home country bias. And that's the type of bias where we want to invest in something that we know. And if you're here in the United States, you're comfortable with U.S.-based stocks and companies here, but you're less comfortable maybe with a company that's headquartered in Europe or Japan or China or somewhere else. And so our bias is to invest in something that we know and we're comfortable with. We also have another bias called status quo bias, and that's where you would much rather leave things as they are than maybe make a change when fundamentals tell you that there's a reason for the change. I'd much rather just it's not broke, don't fix it. Let's leave things as they are. Another one is confirmation bias, and I can tell you, I think our investment committee And then our financial advisors above and beyond that do a really good job of trying to avoid confirmation bias. And what confirmation bias is it's really just looking for information that confirms what you want to hear. And one of the jobs that we do is to make sure that we're reaching out to all other types of economists in different areas to get all the various information, so that we're not just looking to confirm that, yeah, maybe we're at a market bottom, or, yeah, we think interest rates are going to go up, and hey, we found 3 economists that agree with us, so therefore, that must be what it is. Your advisor and your investment team are doing their best to make sure that we're not avoiding it, but doing our best to not pay as much attention to it. And then overconfidence bias, I think some investors, do suffer from this a little bit. It's basically just, feeling that you're too confident in the investment based on the information that we have on that. And why do we talk about biases? Why is this important? I'll tell you that the CFP board, which is setting up education requirements and experience requirements and things like that for certified financial planners, they added behavioral finance as a required course recently over the last couple of years here, because of how important investor biases and behavioral finance in general are to making investment decisions, because these biases do shape our values and our attitudes. You may have a bias towards socially responsible investing. That can be perfectly fine, but at least know that that's your bias. And, as a matter of fact, as it relates to socially responsible investing, the historical trends of socially responsible investing have changed drastically, maybe arguably because of a reduction to a certain extent in some of those biases. Or maybe you just choose that, hey, I only invest in stocks and cash, I don't buy bonds. So maybe I have a bias to that, and we realize that, well, at least you hopefully will start to realize that maybe there's something more outside of just stocks and cash. And so before I turn it back over to Jim and talk about, where are we, maybe where are we going, and some of his final thoughts, I would really just wrap up by saying that it's important to be aware of the biases that we have. They shape who we are, and so that's okay. But it's important to be aware of that when you're working with your advisors and we're coming up with our decisions on our overall investment strategy.
Thanks, Dr. Rand. So before we ask Jim his final thoughts, and really as a representation of our investment committee, I want to take this opportunity to describe the process that we use at the Wealth Consulting Group in terms of research and how we work on the investment committee for all the advisors that you may be working with, if you're not working with one of us, Chris or I, right? So on all of our advisors' behalf, we meet formally on a weekly basis every Tuesday morning. There are 8 active members of the committee. We purchased a lot of data. We spent a lot of money on software and tools to buy research from all different places. On top of that, including in our own thinking, are the thoughts of some of the brightest minds in the world when it comes to money management. On a quarterly basis, we have all of our portfolios looked at and put through like a stress test and analysis by one of our investment partners. For example, last quarter, we did it with Goldman Sachs, and give us some good views. And we're looking for, like Chris said, we're not looking for other people to validate what we think. We're looking for differing opinions. And by the way, we get some really good differing opinions from different places, where we ask for that information, institutional money managers. And so we do that on a very consistent basis every single quarter. On top of that, again, we're communicating with different investors and money managers all the time, economists all the time on a regular basis. And then we try to take all that information and make decisions that go into the client portfolios on a day-to-day basis. So we have eyes on our client portfolios every single day. So I want to reiterate how that works. As we have said earlier, we're trying to give you a little bit of more of an optimistic view about what's going on out there, because we really don't think it's as bad as it could be, really. And I personally don't think the stock market's going to do what it's done in the past when we've had some really severe declines, like with the financial crisis or the dot-com bubble, those types of things. The consumer is still really strong, And it really is just going to take some better inflation data to get the Fed to reverse course. And when that happens, I really believe, because of the health of the consumer and the U.S. economy and companies right now at the moment, that we really have a great chance for an economic, not just an economic recovery, but certainly a stock market recovery that could come very quickly. But with that said, Jim, how do you think things are going to work out here?
Yeah, thanks, Jimmy. So given all the things that we've talked about, and Jimmy, I'm glad you brought up, that investor sentiment survey. So some of those indicators, like, they look really bad, and it's a contrarian indicator. When things look that bad, that's usually a great buying opportunity. That's usually around where we see a bottom. So I think it was Warren Buffett who said, when others are fearful, that's when we need to be greedy. When others are greedy, that's when we need to be fearful. He said something to that effect. So I just final thoughts here. Markets are going to remain volatile through September, maybe all of October, but we may get this bump from what we've seen with midterm elections and how there is a calming effect, and that's really just because there's been some uncertainty that's been removed. Now, should we have something with Russia and Ukraine announcing a ceasefire or an end to the war, that's going to help remove some uncertainty as well. So the markets do tend to climb this wall of worry. That's a natural thing, and as they do, there's some resilience that is built into the market. So we will expect some more volatility. So the other thing here is rates are moving up so high, so quickly. We do not believe that rates are going to stay this high for a long term. And that's just simply because as inflation comes down, the Federal Reserve can take their foot off of the brakes. And if needed, they can put their foot on the gas, which means that they can cut rates in anticipation of trying to jumpstart the economy again. And so those higher rates that people are seeing, it may be very, very tempting to say, hey, you know what? The bonds are volatile, the stocks are volatile, even commodities, all of these things are volatile. I'm just going to put my money in cash, because cash is paying, 3.5% to 4%. So that's really a temptation that a lot of investors might be having right now. But if you're a long-term investor, and going back to those charts of the best days and what the market does after bottoms, there's a massive potential to earn much more in stocks. And I would argue this is the rare opportunity that you can actually do well buying bonds and stocks, that normally they don't move up together, but we've seen them move down together. So I think it's natural to see them actually move up together again. So those are the final thoughts. Anything else you would like to add, Jimmy?
No, if you can just put up the disclosure page and leave that up for our compliance folks here, that'd be great while we close out the call. We didn't want to make this presentation too long. We want to have people sit through the whole thing if they can, and we want to hit the major points, which again Jim summarized there. That while we have inflation still at very high numbers, that we believe that inflation will be coming down. Even there are some reputable firms out there like Morningstar, for example, that I've read a recent report that says that they're looking for inflation to come significantly down. And towards the end of next year. And so, that's probably going to be the precursor to the Fed making a change. And you've probably heard the term before, don't fight the Fed. So I guess it works both ways. And we've hopefully shown you some reasons on why we don't believe market timing is the right thing to do for a prudent investor, for a long-term investor, for an intelligent investor. And we are actively managing sectors and doing the best job we can to produce the best results, regardless of what's going on out there. But we want to remind people, especially people that have the ability to put money to work. If you're sitting on dry powder, cash does sound attractive. And if you're really going to be using the money for something in the near term, that's the best place to go for sure. But for longer term investors, this represents a great buying opportunity, we believe, for some of your money, maybe not all at once, but certainly at these prices, much lower than where we were a year ago, and we think we'll be much higher down the road here. So for people that are accumulating wealth, and we think these are good opportunities to add, right? So with that, we encourage you to talk to your financial advisor, and know that we're behind all of them, a whole group of us, that work on a team for the advisor, supporting their business and being a partner for them to help with their relationships with their clients, and hopefully many of you out there. And so if you ever need anything from us or communication, just work that through your financial advisor. And we really appreciate if you listen through this call, your time, and we thank you. All right, Dr. Rand and Jim, appreciate it.
Thank you.
Bye-bye.